So today I'm going to walk you through 8 assets that financially successful retirees tend to avoid and why you should too. I'm a certified financial planner and owner of a fee-only financial planning firm. Every year I help clients transition from growing wealth to protecting it. The biggest surprise, it's not always market volatility or healthcare costs. It's how poor investing choices can quietly undermine everything they've saved. Most retirees don't realize it's not just about how much they've saved, but what they put their savings into. You can follow every savings guideline, be disciplined and retire debt-free, but if you sink your money into the wrong assets, you risk sabotaging your future. The danger, many of these assets can sound smart: private real estate funds, annuities with downside protection and upside potential, and decentralized currencies. But beneath the surface, they carry massive hidden risks, especially for retirees. In this video, we're going to cover 8 assets that wealthy retirees almost never invest in, not because they can't afford them, but because they understand the behavioral traps, hidden costs, and timing risks that others tend to ignore. We'll break down what the assets are, why it's dangerous in retirement, and how to avoid it without feeling left out. Each point is backed by behavioral finance research, real-world examples, and smarter alternatives used by confident retirees. Let's get into it. First on the list is one of the most talked about asset classes these days: cryptocurrencies. This includes Bitcoin, Ethereum, and thousands of other digital tokens. And while the stories of overnight millionaires are compelling, for a retiree, these are speculations. Cryptocurrency's defining trait is extreme volatility. It's not uncommon for major tokens to swing 25% in a single month. For a retiree that relies on their portfolio for income, a drop like that, combined with withdrawals, can permanently damage their portfolio. Your portfolio's job is to provide stable income, and volatility is the enemy of that stability. Government bodies also share these concerns. The U.S. Government Accountability Office has called crypto especially risky for retirees, citing its volatility and lack of cash flow. The Department of Labor has also issued strong warnings against including cryptocurrencies in 401k plans. This is why very few 401ks offer crypto. Plan fiduciaries have a legal responsibility and duty to select prudent investments to offer to their participants. And crypto lacks the traits of a traditional retirement asset. It doesn't generate income, and its valuation isn't based on business fundamentals. If someone suggests putting a significant portion of your retirement funds into crypto, it may be a sign that their risk tolerance is not aligned with yours. Next on the list is meme stocks. Names like GameStop and AMC became famous for their explosive price movements. And while some traders made a fortune, buying these stocks is participating in a speculative event driven by social media hype, not by business fundamentals like revenue or earnings. I once reviewed a retiree's portfolio where they bought a meme stock at $12 based on Reddit forums, promising that it would go to $50. It briefly did, but then collapsed to $5. He lost 60% of his money, which was 2 years of property tax payments for him. That money was just gone. At age 62, you really don't want to work a few more years just to make up for a loss like that. Meme stocks are fueled by the fear of missing out, or FOMO, a classic behavioral trap. It's more like gambling than investing and has no place in a retirement account meant to preserve capital and generate reliable income. It is often best to leave meme stocks to speculators who can afford to take on huge losses. Now we turn to a hazardous category for long-term investors: leveraged and inverse ETFs. These funds use derivatives to deliver 2 or 3 times the daily return of an index, or the inverse of that return. While doubling the market's gains sounds really appealing, the mechanics of these funds can make them really highly problematic for a retirement portfolio. The critical issue is their daily reset. These are short-term trading tools, not buy-and-hold investments. Over time, the daily compounding creates a mathematical drag called volatility decay that can erode your principal even if the underlying index is doing well. For example, in a volatile year, a 2 times S&P 500 ETF could actually underperform the index itself because of this volatility decay. If an index goes up 10% on day 1 and down 10% on day 2, a standard fund is nearly back to where it started. The leveraged ETF, however, suffers a magnified loss that is really hard to recover from. These are complex tools for professional traders. If you feel you need higher returns, a more prudent solution is to adjust your allocation to traditional stocks and bonds, not to gamble and add complex trading instruments. Let's move on to the world of penny stocks and microcaps. You may have heard about this from the movie The Wolf of Wall Street. These are stocks of very small companies that trade on over-the-counter markets because they don't meet the listing requirements of major exchanges like the New York Stock Exchange or the NASDAQ. The appeal of penny stocks is that lottery ticket potential of buying the next big thing for pennies on the dollar. But for every success story, there are thousands of failures. A major problem is the illiquidity. There are often very few buyers of penny stocks. So if you need to sell, you might not find anyone to buy your shares at a fair price, which is trapping your money into that penny stock, or worse, selling at a huge loss. These companies are also really opaque, lacking the audited financial statements required on companies of major financial exchanges. This lack of transparency makes them a breeding ground for manipulation built on unproven ideas with no revenue. A good rule for any investment is if you cannot review 3 years of audited financial statements, it's not for your retirement funds. Next are non-traded real estate investment trusts, or REITs. The sales pitch is often really compelling, promising really high yields and stable income, supposedly backed by real estate. The first problem is illiquidity. Your money is often locked up for 7 to 10 years. Unlike a public stock, you have no easy access to your capital, which is a major risk for a retiree who might face unexpected expenses. Second are the fees. Upfront commissions on these types of investments can exceed 10%, meaning on a $100,000 investment, $10,000 goes to commissions. The third is valuation. The value isn't set by a market, but is instead estimated internally. We've seen really large non-traded REITs slash dividends and freeze redemptions in changing economic conditions, which leaves investors unable to get their money out even at a loss. So liquidity is a necessity, not a luxury. If you can't sell an asset at a transparent price, you don't really control it. Now let's talk about an asset trusted for centuries, physical gold. Many turn to gold as a store of value and a hedge against inflation. And it's done really well in 2025, but it's important to understand its role in a retirement portfolio. The main drawback of physical gold is that it's a non-productive asset. It doesn't pay interest or dividends like a bond or a stock. Its return is entirely based on its price going up. For a retiree who needs cash flow, owning an asset that generates no income can be a major drag on your financial plan. Plus, owning physical gold involves storage and insurance costs, which eats into the returns. Selling physical gold is also less convenient than selling a stock. While some have done pretty well with gold, for retirees that are focused on income, it's best to be used as a small diversification tool, not a central holding. Next is a product often positioned as a safe all-in-one solution, whole life insurance. The idea of a lifelong coverage combined with a cash value component can really sound appealing, but for most people over 55, using it as a primary retirement investment vehicle is really inefficient. Whole life premiums are much higher than those for term life insurance, which can be a real strain on a retirement budget. A large portion of early premiums goes to commissions and fees, so the cash value builds really slowly at first. The guaranteed return on the cash value is also typically pretty conservative and may not even outpace inflation. Often, the buy term insurance and invest the difference strategy is a lot more effective. You get affordable coverage for the years that you need it and invest the savings in a diversified low-cost portfolio with better growth potential and liquidity. And finally, our eighth asset, let's look at fixed index annuities. This sales pitch is one of the most powerful in finance. Stock market gains with no risk of losing principal. This best of both worlds promise plays on a retiree's fear of loss, but the reality is a lot more complex. Your upside is often limited by caps, participation rates, or even spreads. For instance, a cap rate of 5% means the most you can earn is 5% even if the market gains 20%. A participation rate of 80% means if the index gains 10%, you're only credited with 8%. On top of that, these index gains usually don't include dividends, which is a major component of total stock market returns. Another drawback is illiquidity. Fixed index annuities have really long surrender periods typically, often 7 to 10 years, with steep penalties for early withdrawals. The promise of market upside with no downside often comes at a big cost of limited growth and restricted access to your money. If you've listened to this and recognized one of these products in your own retirement portfolio, the intention is not to make you feel bad. The financial services industry can make these products sound really appealing when they're sold. The important thing is that you're now informed and can make better decisions going forward. To learn more about what to invest in as a retiree, make sure to watch my previous video on investments that are best for retirees. As you approach retirement, after age 55 typically, your job as an investor is going to evolve. It's no longer about maximizing returns, but about preserving capital and generating reliable income. It's about playing defense rather than playing offense. This means avoiding the behavioral traps and hidden risks in these 8 areas: the volatility of crypto and meme stocks, the decay of leveraged ETFs, the illiquidity of penny stocks and non-traded REITs, the lack of income from physical gold, and the complexities of whole life insurance and indexed annuities. Of course, you can always have a little bit of crypto or gold or a meme stock that you actually believe in. But the broader point is that 95% of your portfolio should be built on diversified, liquid, time-tested assets that will produce income for you. By sticking to the core principles that fit your stage of life, you can build a portfolio that helps secure the retirement you've worked so hard to achieve. If this was helpful, please consider liking and subscribing, and consider sharing this with a friend or a family member who might need to hear it. And if you are retiring soon and want a fiduciary, fee-only financial planner to help you feel more confident, schedule a consultation using the link in the description. Otherwise, see you in the next video.